Hello everybody and welcome to the channel. I hope you guys are doing okay. Let me introduce myself. My name is Andrew. I'm a 24-year-old long-term stock investor. I've been considering doing this for a while and decided now is as good time as any with the crisis going on, so here we are. I want this channel to document my journey to financial independence. I'd like it to be a place where I can talk and discuss the stock market, the economy, personal finance, and hopefully help others along the way. I will address real quick that I do know the audio is going to sound probably pretty garbage. It is my first video, so I'm not really sure where this is all going to take me. With time, I think I'll probably add more cushions and maybe get a better mic, but for the time being, I do apologize if the audio doesn't sound good. And if you have to click out because of that, I understand. Just to give a little insight, I've been investing for the last 5 years, and I focus most of my positions into companies that I buy and hold for the next 10, 15, 20 years, regardless of what the market does. I enjoy keeping up to date with the latest economic data, researching companies, and reading financial reports. I'm just kind of a finance nerd. I hope to be able to share my knowledge and insight with others and to continue to learn and expand that knowledge along the way. I'm never going to pretend to have all the answers or sell you some course on a trading strategy. I find that shit to be ridiculous, but to each their own. I'm always going to advocate for you to do your own research before investing your money. It's important to understand that we all have different financial needs and desires, and one person's investment strategy might not work for you. And so it's not that there's anything wrong with that. It's just we have to remember that we all have different goals. It's important too that you know that everything I share in here is my opinion and should be treated as such. I'm not a financial guru. I don't have all the answers. I'm not a fiduciary insured financial advisor. I'm just a guy who likes to invest and has some kind of insight. I've done pretty well over the last couple of years, and so I feel like I have something to say. It doesn't mean that it should be taken as this is the answer and this is the way, because I don't believe that. I think that I am wrong. Not all the time, but there are times I'm wrong, and that's okay. With all that in mind, let's get started talking about the unemployment crisis and what this could mean for future returns in the market. Now, I'm sure all of you know that the record-breaking levels we're setting with unemployment claims on a weekly basis, topping over 40 million initial jobless claims in the last 8 weeks. We are currently seeing the fastest job loss in history and could reach levels of 25% unemployment in a few months. The last time we saw levels of unemployment like this was the Great Depression of the 1920s. To paint a more vivid picture of how many jobs that is, the current crisis has lost more jobs than were created since the last financial crisis of 2008, also known as the Great Recession or the housing bubble. The chart we're looking at right here is those initial jobless claims. And I don't have the overlay for our recessions, but we can kind of see the peak points. There's one here, 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 there. We have the Great Recession 2008. And what these are the amount of people who file for unemployment on a weekly basis. It doesn't mean they'll get approved or that the job is lost, but these are people who are filing an initial jobless claim. And obviously, the current crisis is at a point we've never seen before in history. The highest point previously was around 600,000 people back in the 1980s during that recession and stock market crash. And our current levels, we're seeing 2, 3, 4, 5, 6, 7 million initial jobless claims. That's just never happened. And so it's kind of a scary number, and it's important to understand that. Like, this isn't normal. So don't be worried if you feel like things are abnormal and out of space, because they are. This has never happened before, and so we need to understand that. This is another chart that we use is the actual unemployment rate that is reported by the Federal Reserve. This one is from the St. Louis Bank branch. What we're going to see is these are the unemployment rates that are reported by the branch every month. The gray shaded areas you're going to see are the recessions, and you see that they start July 1973. This one ends in 74. Same thing. The financial crisis started late 2007, ended late or mid, 2009. And these numbers are actual unemployment numbers. These are people who have been approved that we know they lost their job. It is a little bit of a lagging indicator because a lot of this information is reported a month after the actual job was lost. So that's why we like to pay attention more to this initial jobless claim, because it's on a weekly basis. It's more to the point. This is what's happening versus this is more of a lagging. Oh, yes, we see that unemployment's at 14.2% for April, but that's also because they cut off basically the measurement that they take for unemployment about mid-April versus letting the month follow and finish through. There's really no way to sugarcoat it. Things do not look good, and in many ways, it's kind of a total shitstorm. For millions of Americans who've lost their jobs through layoffs and furloughs, from businesses that could go under completely, families are requesting mortgage forbearance, renters demanding rent forgiveness or cancellation, not to mention the many bankruptcies that are coming ahead. You would think the market would be tanking, but if we take a look over at the S&P 500 Vanguard ETF called VOO, we'll see that since the low of March 23rd, let me get to the actual day, there we go, we're going to see a gain of over 34.8%. It's down a little bit today, but you see there's been a big rally. If you're new to the market, this is going to seem completely backwards. How can the market be climbing higher when there's so much negative economic news that keeps coming out with no end in sight? Well, it's important to understand the stock market is not the economy. The market is a way of predicting what people think the economy is going. It moves up and down based on economic data, news, good and bad, guidance from companies, and it also moves depending on how retail investors, aka me and you, as well as big financial firms and the Federal Reserve, see the coming future. You see, the current price is never really the intrinsic value of a company or stock, but rather what people are predicting the company is going to be worth over the next 12 months. Now, do I think that the market is right and things are just going to snap back to normal? Well, of course not. I live in a state currently still under lockdown protocol, and I can simply tell you by observing my surroundings, it's going to take a while for things to recover. I don't think people were ready for a financial crisis like this. I mean, no one can really prepare for it. Companies can't expect to be shut down for 3 to 6 months and be okay. It's just never happened before in history. And so I think that the markets are being very optimistic on a vaccine and a recovery process. That we keep hearing people talk about there's going to be a V-shaped recovery. Is it a U-shape? Is it a W? And to be honest, I don't know, but I'm going to be a little more cautious with how I approach my investment strategy. The markets have just recovered, in my opinion, too quick, too fast, and I think it's more than likely that they're going to have a pullback. Now, what am I doing currently? Well, I have pulled back my investment strategy slightly, and I do want to emphasize slightly. I'm not selling any positions or rushing into cash because I think the markets are going to tank. I just personally feel that the markets have climbed extremely fast, and I think investors are being really optimistic in a recovery. I do think that we did have an amazing record-breaking month in April and the beginning of May, but I still think that's gotten a little bit ahead of itself, and it would be more than likely to see the markets pull back. Personally, I would like to see a 10% pullback from current evaluations. With all the uncertainty that's going on in the market, it just seems ridiculous to be paying such high multiples. In fact, if we switch over to the S&P 500 price to earning ratio index, we'll see that we're sitting around valuations around 21.4, which is historically pretty high. We can see that down here around the median and mean, we're looking around 14 to 15 price to earning ratios. I just think that evaluations are a little rich with all the uncertainty that's going on in the market. We don't know where the economy is going to be at in the year. We don't know where employment is going to be at in the year. We don't know what businesses are going to struggle or not make it. And I think that pay such high multiples is kind of ridiculous. And I think that people are being a little short-sighted and thinking that everything's going to be fine. And it's more than likely that we will see that pullback that I'm hoping for. Does that mean that pullback will happen? No. But if it does, I will increase my investment strategy. I like to buy when stocks are falling. I'm just kind of a contrarian that way, but I'm not going to pretend to predict the market. I know over the long run, as long as I'm investing in good, strong companies that I believe in, the long-term return will be worth it. I personally practice using both ETFs as well as individual stocks. I know there's some controversy behind that, but I personally find that I get a good mix of both. I'm not going to be the kind of guy who says you know, invest in an index fund and you'll be fine. And I'm not going to be the guy that says index funds are a waste of time. I think they're a tool that everyone should use and they're useful, and just use them based on your individual needs. As Warren Buffett once said, never bet against America. If you look at any chart over the last 50 to 100 years, that you'll see that the stock market has recovered 100% of the losses 100% of the time. I like that stat because it's important, and I think it really does paint a picture that in times of uncertainty, just understand that we have never had a crisis that has crippled the economy but never recovered. We've gone through multiple world wars, we've gone through economic depressions, commodity crises, health crises, and we've always come out on top. And so I think that for the long run, it's important to remember that and see that I think that the market will be fine. It's just going to take time, and no one knows how long that's going to be. Now, if you're new to investing, I would recommend what I did, and I recommend all new people do, is open a brokerage account with 0 commissions. Now, when I first started investing, that wasn't available. Robinhood came along. As you can see, that's the account that I'm currently using, but I do have accounts with multiple other brokerages. I think the best strategy for anyone just getting started is to just open the account, set up an auto deposit, and forget about it. Have it automatically invest in some kind of index. It could be Vanguard ETF, it could be the VTI, which is the total stock market index. I don't care who is the one who owns it, but I think that just getting started, the best thing for you to do is just get in. The important thing about investing is that the best ingredient to having high returns is just time in the market. It's not timing the market, it's how long are you in the market. And I think that people get this construed idea that they need to have tens of thousands or $100,000 to investing. I had that idea before I got into the market. I didn't know how to do it. And so it's important to know that you can start with a $5 account and just add $5 every week. And over time, you're going to see that account climb and climb and climb. And eventually, at that point, I would start taking not more risks, but do what you're comfortable with. If you feel that you're watching the markets and you're more involved, then start researching companies. And we'll go more into that detail and how to do that in later videos. But the whole point of this video is to kind of introduce myself again, just show what I think is going on with the economy and where things are going to go and what I'm doing. I hope this was helpful. If you are interested in opening up a brokerage account, I have links in the description. They'll give you free stocks and me free stocks. You don't have to if you don't want to. Use whatever platform you want. One that I always suggest is M1 Finance because they have the fractional shares that not all companies have. Robinhood has it, but again, they don't offer it right away. It's something you have to wait in line for versus M1 Finance. Their platform is a little wonky, but it has a really great investment tool when it comes to fractional shares and auto investing. I hope you've all enjoyed the video. Being my first video, I'm always willing to take constructive criticism. If there's anything you want me to talk about or you have questions, leave a comment below, and I hope to see you in the next video. Cheers.